this leads me to are, how can investors comfortably invest in any financial service company when a decent percentage of the AAA-rated companies have false and misleading financials? And I guess the follow-up question is, why don't the rating agencies do some independent due diligence from an accounting standpoint so that they can help serve as a watch on this?
Financial companies are more difficult to analyze than many companies. I mean, it is more. If you take the insurance business, the biggest single element that is very difficult to evaluate, even if you own the company, is the loss and loss adjustment expense reserve, and that has a huge impact on reported earnings of any given period. And the shorter the period, the more the impact can be from just small changes in assumptions. We carry, we'll say, $45 billion of loss reserves, but if I had to bet my life on whether $45 billion turned out to be a little over, a little under, I mean, it'd be I think a long time. And you could just as easily have a figure of $45.5 billion or $44.5 billion. And if you were concerned about reporting given earnings in a given period, that would be an easy game to play. A bank, it basically is whether the loans are any good. And I've been on the boards of banks, and that's, I've gotten surprises. It's tough to tell. It's financial companies. If you're analyzing something like WD-40, or See's Candy, or our brick business, or whatever, they may have good or bad prospects, but you're not likely to be fooling yourself much about what's going on currently. But with financial institutions, it's much tougher. Then you throw in derivatives on top of it, and it's no one probably knows perfectly what some of it, or even within a reasonable range, the exact condition of some of the biggest banks in the world. I don't think those people were negligent, and it's very, very tough to know precisely what's going on in a financial institution. Charlie and I were directors of Solomon, and Charlie was on the audit committee, and I forget the size of a few of those things that you found, but what wasn't found. And that doesn't mean that people below are crooks or anything like that. It just means that it's very tough with thousands and thousands and thousands of complicated transactions, sometimes involving the computations involving multiple variables. It can be very hard to figure out where things stand at any given moment. And of course, when the numbers get huge on both sides and you get small changes in these huge numbers, they have this incredible effect on quarterly or yearly figures, because it all comes lumped in. Those adjustments come lumped in a short period of time.
When the financial institutions are owned by governments. In fact, some of the worst financial reporting in the world is done by governments, and governments, institutions like government banks in China, etc. So if you don't like the lack of perfect accounting in financial institutions, you're in the wrong world.